The Dow falls again. Why should workers bail out greedy? Many people do not own real estate, have never watched a real estate show on TV, or attended a get-rich-quick scheme seminar. Many people do not own stock, have an IRA, or a pension or health insurance. These people work for a living, yet they will be asked to bail out the aristocratic gurus of Wall Street, who will not take responsibility for their failures or even admit that they have been seriously vain and greedy. The government is there to protect the people from fraud, not encourage it. That's the way it should be. To imply that the people somehow brought the financial crisis on themselves is shameful. Why is it that when right-wing philosophy fails, as in the free market will regulate itself, they immediately blame the people then? Alan Fishman, chairman of Washington Mutual, got $20 million for working 17 days. We the taxpayers had to buy his bankrupt bank's failed assets. Shame on Washington for making us taxpayers pay for his golden parachute. This is a sin. This is an abomination. And it's a great time to be afraid. The Dow plunges 679, closes below 8,600. In some situations, fear is the appropriate response, and this is one of them. Why? The bailout plan is riddled with loopholes, loophole after loophole, and new crises are brewing for U.S. cities, states, and oil refiners. Fear works best when it comes from knowledge and not terror. It is good when it bolts from your guts to rouse your brain from complacency, forcing you to act more on instinct than just reason. It cuts through Wall Street's myths to let you know that danger lurks and you'd better do something. In such situations, he who panics first panics best. Loopholes in a joke bailout. Minimization of long-term costs and maximization of benefits for taxpayers. Check out section 113 of the bailout bill. This is the section that Congress haggled into the bill to ensure a payoff for citizens if mortgages purchased from banks are later sold for a profit. Bank lobbyists snookered the government by sneaking in an exception under subsection 3A, conditions on purchase authority for warrants and debt instruments. The clause, titled Exceptions de minimis, states if any debt instruments worth less than $100 million won't trigger the payback provision. So then, banks will simply issue their debt in amounts of $99 million or less, and avoid allowing the government, and thus taxpayers, to get a piece of the bank's profits. It's a joke. It's a great big joke. Other traders who scanned the bill have come to the same conclusion through their own prisms, agreeing that the bill would provide only an illusion of action, while totally failing to address the key problems facing the financial system. Too many houses will remain on the market. They were bought with too much leverage that is vaporizing. And those losses have left banks with too little capital from which they can lend. Even worse, the traders point out, the government can make money on the loans only if it pays so little for them that they can be sold at a much higher price. And yet if the government doesn't pay enough, then the banks won't receive enough to make a difference in their balance sheets. So here's how the taxpayers will be cheated. Banks will take advantage of the suspension of mark-to-market accounting by stating that loans originally held at par are the equivalent of the purchase price and now valued by the market at 20 cents on the dollar will really be worth 85 cents if held until the loan matures. The banks will then sell the loan to the government at a fake discount of 75 cents on the dollar. The lobbyists made sure this bill was rammed through so that these rip-offs couldn't be fixed in committee. Said one trader, everyone on the street knows it solves nothing, absolutely nothing whatsoever at all. The Dow-Jones Industrials fell under 9,000 for the first time since the summer of 2003, as investor confidence in financial markets appeared to collapse. At the close, the Dow was down 679 points, or 7.3% to 8,579, its second largest one-day point loss. Only the 778-point loss on September 29th was larger. At these levels, the crash of 2008 has left the Dow 39.4% below its record close of 14,164.53, and the S&P 500 down 42% from its record close of 1,565.15. Ironically, both records were set exactly 1 year ago today. Ironically. Well, there's something about that. It's not a coincidence at all. No, there's a reason it was exactly 1 year ago today. And all this is bigger than most people actually realize. Much bigger. All systems are broken. All systems must change. A key event appeared to be news that General Motors was facing a new downgrade by Standard & Poor's. The stock was at $4.76, down 31%. The crash of 2008 crushes stocks in a wild last hour of trading. The Dow's loss tops 7%, and the S&P 500 drops 7.6%. Investors are fleeing the markets, skeptical, very skeptical that fixes to the credit crisis will work. General Motors shares fall nearly a third on fears it won't survive. There's no safe place to hide. Panic selling has set in. Yes, panic. The cause of the ongoing market crash has been a credit crisis that erupted in the summer of 2007 as turmoil slammed the U.S. housing market. Banks have been unwilling to lend to each other except at very high rates. The Dow loses 630 points in 150 minutes. The 30 stocks in the Dow were all lower. Yes, mass panic is starting to set in. The crash of 2008 stock market. Yes, it's going down rapidly. And, like I said before, this is connected to something bigger, much bigger. All systems have become broken. Greed has taken over. Greedy people have ruined the economies of the world and the economy of the United States. Pure, unadulterated greed is ruining everything. Covetousness. Anyway, these are more signs of the end times, last days, transition days, and there are many signs.